Broadcasting live from Peoria, Illinois. Welcome to the Enlightened Investor. Today, Mike, we find ourselves after 13 years of incredible market performance, and yet we're finding there's $4.6 trillion of cash on the sideline in fear. Can we talk a little bit about that today? What's going on?
Yeah, I look forward to talking about that. I mean, and you can't blame people. I mean, you think about it, the markets since 2009, the last 13 years, and if we define the market as the S&P 500 as an proxy, 12 out of 13 years are up. Yep. Annualized return 16%. One down year. Well, due for a drop, right?
Due for a drop, and people are used to this, like rule of doubling, right? If you have 16% rate of return, you get doubles every
quicker,
right? 4 or 5 years,
4.5 years. Well, it's even more so dramatic when you look at the NASDAQ, which is the tech index proxy, QQQ, if you want to use that. Last 13 years, annualized returns 23%.
Man, that's incredible.
Yeah, it's a double every 3, right? How about that?
Yep.
And also, too, if you were to dig down deeper, I mean, a lot of that performance from the S&P and from the NASDAQ is getting driven by less than a dozen names.
Right. There's still a lot of underlying
so I understand why people have fear and trepidation of putting money in. But I think what we'll do today is take a look at it a little deeper and you'll get a better understanding of why that's kind of foolish to be sitting on the sidelines with $5 trillion.
Well, I'm going to grab that quote right there. I'm going to give you a new one from Peter Lynch. How's that sound?
Okay.
There's a lot of fear out here. Listen to this, folks. More people have lost money waiting for corrections and anticipating corrections than the actual correction itself. And you know who said that?
Peter Lynch.
Yes. And so, what we want to tell people is that, when it comes to the market, which is sort of a random generating machine to the upper right Cartesian heading up, it's moving upward, but who knows what tomorrow is? There's some volatility. Does it really matter when we invest? Actually, what do we find out here?
Yeah, that's actually, I think my back office just wrote a good paper on this, and I think we'll throw it up on the screen and show this. But what it is they looked at the last 30 years of market returns, if you measure by the Russell 3000 index, and then they took and it had invested 6 different times with $10,000 at either all-time market lows after the market had dropped 10%, they put it in at the low, or then also vice versa, they put it in at the high after a 10% rise, okay? And then they compared it just to the actual market return. What was really interesting, and we'll dig into this deeper, but what was interesting is if you were just went for the whole time period, 30 years, the Russell 3000 index return was 10.2%. If you bought at the lows, you got 10.6%. Or I'm sorry, if you bought at the highs, you got 10.6%. And if you bought at the bottom, you got 9.3%. Or after the bottom, I should say.
Yeah. So if you're like the worst investor in the world,
you still made 9.3%.
9.3% over 30 years.
And if you were the best,
the greatest market timer in the history of the last 30 years, you'd get 10.6.
Correct.
So really, it's a difference of 1.3. But in the end, that the power of compounding does matter on that. But really, you're still winning with a 9.3% rate of return, Mike. I mean, think about that. If someone was to come to you actually and say, "Hey, Mike, I would like to get like 9.3%," and you say, "Okay," and we'll just do the worst investing of all time, and you still achieve that. That's an incredible story.
Correct. Well, because also if you remember some of the other slides we've done, if you look at the index versus a lot of the actively ran funds, they don't even match the index return.
No,
so if you caught that return, it's great. And also, I mean, you grew. That was $10,000 investments. You could grow it to $350,000.
Yep.
And also, this is just one asset class. So think about it. If you were diversified, you obviously could have maybe even a better outcome from that. And especially, I think the other side issue on this topic is if you look, I don't mean to hammer this home again because we've talked about this lost decade a lot. But I mean, history doesn't repeat, but it rhymes. But if you look at the late '90s and the dot-com boom, we had similar historical returns where the markets got really rich like this. And when things reset and you had the next decade, the markets were negative for the S&P for a decade. But if you had a diversified portfolio in different asset classes, you actually had a very positive outcome.
And that's the story of me, folks. That's the story of me. When I started investing in 2000, it was the lost decade. And frankly, we actually came out all right because we had a diversified plan, and we just, we just dollar cost average in DCA.
Right.
DCA is a great diversification and dollar cost averaging. Those are some of the two great tenets that we can talk to you about.
Well, you think about last year. I mean, you can't blame people. You had if you use the Russell 3000 as a proxy, they had 60 market highs, and the S&P had 70.
Yep.
So I mean, things are very rich, and you can see why people would lead people to have money sitting on the sidelines. But I think the key thing is with this is, are you a long-term investor? Because if you need your money in the next 5 to 7 years, money shouldn't be in the market. That should be in an investment grade fixed income holding.
Right.
But if you're a long-term investor, and people, if you're 60 years old or 65, you're a long-term investor unless you really have some short-term illness or definitely know you're just not going to live a long time. But if you're going to live for 25, 30 years, you are a long-term investor, and you need to be in the market with some of your capital to guard against inflation.
Yeah, so
especially
I think
in today's environment.
Especially in today's environment with the 7% inflation.
Sure.
We're going to talk about and that's coming up in another show. But think about, Mike, I like what you said there. Like, there's a plan for each bucket of money, right? Like, there's a bucket of money for hey, I need a new car coming up in 3 to 5 years. I'm going to put that in either cash or investable grade bonds, fixed income asset. But if I'm going to be investing long run, then you definitely are exposed to this market, the Russell 3000 or something.
Well, yeah, that's the purpose. The purpose of cash isn't to provide, people complain right now with the yields being very low, and especially on fixed income that's investment grade. I mean, the purpose of that isn't to achieve the high yield. It's there for safety and to dampen the volatility of the equity portion, what is the risk. And also what's nice is when you have investment grade fixed income is when you do have these swings and you do have drops, it allows you to have money to rebalance the portfolio.
Yep, some dry powder to give you some ability to.
If you're out there trying to seek yield with your fixed income, you got corporate bonds, or you're chasing longer term bonds for the credit one. You've got hit with the inflation recently, but also if the market's dropping, there's a lot like we saw in March of 20. There's a lot of corporate bond funds, even good ones. Vanguard corporate bond funds, they went down 20% that month. So you couldn't rebalance because your cash went down just like your equities.
Yep. So I guess one of the biggest misconceptions about investing, Mike, is we find ourselves kind of at a market high.
Right.
That doesn't mean we're going to fall off, and we might have normal corrections, but yet there's a lot of intrepidation. But I think the key is that no one knows the future, right?
Correct. But everybody, especially this time of year is when you're going to see all the information. Everybody's making the forecast for the year, and
we've done that.
That leads people to have more cash in the sidelines too. When in reality, I hate that we sound like a broken record, but we're going to continue to tell people focus on what you can control.
Yes.
And you can't control the markets. So what you want to do is control, one, your exposure to the market based on your need, ability, and willingness to take risk. Diversify the heck out of it. Make sure your investment costs are low. And then really focus on, the friction to your money, taxes, where is it located, asset location is important, your withdrawal, your spending sequences, where you're spending from are important.
Yep.
Tax loss harvesting is important. And even then when you're going to go further, you get into estate planning where you actually have different assets is important because you get stepped up in basis. So there's a lot of things you can do to really add value. And unfortunately, there isn't much talk about that. There's a lot of noise out there that tells you to do things that you shouldn't do.
Yeah, we were even talking pre-show with our producer here that, the more people watch, the CNBC and other news in general, right? There's a lot of fear. And I think, go ahead.
Solidify that, right?
Yeah, and I think as a financial advisor, you see a lot of your time is spent on human behaviors and sort of help guide them to making the right decision based on the information that they have and their goals and their plans.
Right. Well, you see that on TV too, right? You see the ads for gold. And I heard one on the radio the other day about some company that sells food storage for 30 years. And I saw an ad for some kind of REIT on TV, and I didn't look into it at all, but it sounded too good to be true. And if you're going to buy REIT, which is a good part of a balanced portfolio, you can do it with an ETF or an index fund at a very low cost and be broadly diversified.
Yep. Well, there is a subculture out there, Mike, that you know about that are, the preppers, right?
Sure.
They're worried about the future and self-sustainability. And
Yeah.
I think there's some value to that too, but like your own gardening and things
Well, I
like
mean,
this.
I
But
always
at the
like
same
telling people, if
time,
we're going to have Armageddon, but rather than have gold, you're better off to have some butter and some eggs and chicken and cow.
how about
right?
some Hot Wheels cars for the grandson?
Well, for the
huh?
grandson, yeah, we were busy with doing that.
That's
last
an inside
night.
joke, folks. Mike played with his grandson last night with
had
the
a
Hot
house
Wheels.
guest. It was
Yeah,
great.
house guest. But anyway, there's a lot of value that you could
Yeah.
add.
So I think we should put that up at the end. I know we're
Yeah.
beating a dead horse. We'll put up what we can focus on and kind of where that adds value. That was provided by Michael Kitsis. You can Google him. He's probably one of the leading proponents of financial planning and really a thought leader in the country for financial planning. And that just shows there's a lot of ways you can add value. And it's not by sitting on the sidelines trying to time the markets or finding the next Peter Lynch or whatever.
Wow, there's some words to wisdom right there, folks. I think we'll end with that.
Okay,
What do you
good
think
deal.
about that? Anything else to add, Mike?
Not today.
Folks, thanks for watching. Be sure to subscribe, share the channel. We do have that at enlightened-investor.com where we have a lot of extra content that's all for free. We're glad you're here, and we'll see you the next time. Thanks.